Well, there you have it. As expected, a third consecutive cut of 25 basis points, bringing the repo rate down to 7.5%. Still with me in studio as we dissect the decision in greater detail, Maarten Ackerman, Chief Economist at Citadel, and via Zoom, Annabel Bishop, Chief Economist at Investec. Annabel, let's start with you, right? As expected, as I've mentioned, rates cut down to 7.5%. I guess what I found interesting here is that we had a divide between the panel, with 4 preferring a cut and 2 preferring a hold. What have you made of today's move?
Yes, hi. Look, I think it's very appropriate that we do get the 25 basis point cut. Consumers are still struggling in South Africa. Surveys show household financial vulnerability. Interest rates have been elevated for a lengthy period. We've only had 0.5% cut, and of course today's 0.25% will add some relief. I think overall, we do find ourselves in a situation where there's a lot of worry about what's happening internationally. The new Trump administration, what will it mean for the world, for South Africa? Will there be tariff increases from a trade protectionism point? And of course, at the moment, it's been mainly focused on other areas, the tariff threats. So that, I think, accounts perhaps for some of the divergence in the monetary policy votes to votes perhaps saying, we might look to keep a hold at the moment and have a wait and see attitude. The others obviously looking at the weakness of the economy. And our economy was very weak last year. And of course, as well, the vulnerability of households, supportive of an interest rate cut. We think it's the appropriate move. We applaud the Reserve Bank. We look forward to more cuts this year, but we think the next one will probably only be mid-year in July.
Let's talk about, household resilience and the strength of the consumer, Maarten. Looking at the last retail sales print, numbers, or sales rather, were up 7.7%. This, of course, we're looking at, lower inflation as well as two-part withdrawal and just those rate cuts as well coming through in that mix. Do you think the Reserve Bank has been supportive, or rather dovish enough to support the strength of the consumer? Because all these factors boosting consumption at the moment are kind of once-off sort of factors.
Yeah, I think you're spot on. The governor even mentioned now that the lag for interest rate cuts takes, you said, 12 to 18 months. So if you take that into account, a lot of consumers actually haven't even experienced the full benefit of the rate cuts that we are seeing at the moment. So the pickup that we've seen in something like retail sales is probably more the two-pot system, but also a little bit of, we spoke about consumer confidence picking up. But both those put big question marks about the sustainability. So if, this is the rate cuts that we're going to see, that's not really a lot to help consumers going into the second part of this year and going into next year. I don't think that there's definitely more room, just from a consumer point of view, to actually consider rate cuts.
And what did you make of the tone? I couldn't put my finger on it, whether he was cautious, whether he was hawkish. I found that he was a bit more balanced than usual, because I did think he would be more hawkish considering what took place at the Fed's meeting yesterday.
I think it's clear that they are concerned about, let's say, the second half of this year. And whether that number is 4.5% or 5%, it is higher from where we are right now. So that concern is definitely in their view. If I read between the lines, I think there's already a tilt with 2 members voting for hold. I think, assuming that the US kind of scenario remains the same, we're probably going to see one more cut this year. And then if you go back to the Fed cutting 0.5% to start, and we didn't, we're then basically on equal levels with them. Just the 2 scenarios that I spoke about, because I think that's quite important. So the trade war scenario that they referred to, around at 21, that's scary. Inflation at 5, and they had a good answer there in terms of that's 5, assuming that there will be rate hikes to actually keep it there. That's a scenario with actually quite a high likelihood, because if we think about where we're going, that's pretty much what the Trump administration wants to do. I'm not saying the rand goes to 21, but I think we need to prepare for some trade headwinds coming our way. So that we need to keep in mind. On the other hand, he said that You know, if we just speed up reform, and we spoke about that just before the speech, and where the government of national unity is going, it's so important for us to realize the benefit of that. Because in that same scenario, if we get growth to 3%, that's what he mentioned, it paves the way for actually lower inflation and also more steady interest rates. And then, you know, next month is the budget, and we know that, you know, anything in the budget, if we have higher growth, starts to look better. So it puts the urgency of reform on the table. Back to our previous conversation in terms of when are we going to see the growth? Well, the quicker we can implement those kind of policy changes, that will be a big benefit for South Africa.
So, Annabel, as you've heard from Maarten, speedy reforms needed to make sure the economy grows. Governor Lesetja Kganyago mentioned a lot of global risks. He mentioned, you know, low global growth as well as low growth in Europe's biggest economy, Germany, as well as China. How much of a risk is China, Annabel, in terms of looking at it from an emerging markets point of view, especially as we've seen the recent growth numbers coming out positively? In Q4, growth was up 5.4%, and then overall for the year, growth hit the government's target of 5%. Should we still worry about China? That's the question.
Yes, I think the global economy, your first question, is very important for South Africa. We're a small, open economy, very small. And of course, what happens in the global economy matters. China is our largest import trading partner for the export of our commodities. And of course, as you know, we are mineral rich, and mining minerals and metals are our chief exports. So obviously, a slowing in Chinese growth has an impact. China has seen slower growth since COVID, and of course there were very negative effects on that economy from the lockdowns. The economy has not recovered yet, and of course that to its previous growth rates, and of course that is the worry for China and hence for South Africa. If we look at the global economy, we actually saw a contraction in global manufacturing last year, while the service industry powered ahead, pulling global growth. So what we are looking at going forwards is still a moderate global economic outlook. The IMF calls it underwhelming but modest. In other words, it's going to be below trend. GDP growth for the world is probably going to be just above 3%, whether it's running between 3.1 or 3.3% over the next 5 years. That's where the IMF is pegging it. We certainly, for South Africa, obviously benefit when global growth is stronger, providing we have enough electricity capacity, rail and freight capacity, and other necessary factors of input to drive and produce our exports and obviously export them overseas. So these are all concerns, but having a look at another angle, interestingly, for our steel industry, we've heard of the risk of company closures, job losses, and of course as well knock-on effects to indirect industries. Let's unpack this. And of course the industry itself, the steel industry, has made mention of the fact that South Africa's tariff system is not necessarily up to scratch as far as it considers it. And of course talking about cheap imports from China and elsewhere, flooding the markets, damaging South Africa's steel production capacity. And these are all factors. The United States talks about tariffs and talks about protectionism for its trade. And here I think we should maybe worry less about a universal tariff, one which is applied around the world on everything the United States imports at 10 or 20% or more. It doesn't obviously change South Africa's competitiveness in that environment. Everyone's being hit by a big tariff. But what it does do, of course, is push up inflation, weaken interest rate cut expectations, and all of those things we've been thinking about. Another point which to bear in mind, however, is that the economic advisors of the Trump administration have actually been talking against a universal tariff. They've actually been talking more at direct, specific tariffs, and particularly on the semiconductor, steel industry again, and of course as well pharmaceuticals. Now, putting tariffs on these goods, which they wish to onshore production, return production to the United States, is key in their policies. We think that's the direction that tariff applications are going in the United States. It doesn't mean that's necessarily going to be the case, but at the moment, that's the direction. Let's bear in mind as well that tariff threats have been aimed at countries who the president and his administration have felt have not held up their end of the deal to stop illegal immigration, drug smuggling, and other areas that the president of the United States has been very prolific in a speech about recently. So we find ourselves in South Africa probably not being that affected by tariffs. Well, the risk obviously is more for us on the rand front, and of course fewer interest rate cuts in the United States. For the Federal Open Market Committee, the Reserve Bank in the United States, they didn't give us their forecast this time around when they met last night. It's every second meeting. We'll wait to see if they change their inflation forecast, perhaps drop it a bit lower after raising it in December last year. Should they do that, the markets should calm a bit, and there should be more support for further interest rate cuts in the US than there are currently, of only 2. And of course, that then in turn could provide a bit of support for more interest rate cuts in South Africa. So we still are in an evolving global environment. There's still volatility and risks, as the governor said, and hence their caution in only delivering a 25 basis point cut and most likely pausing in March at the next meeting, and probably May as well, waiting to see what the Fed does, because there's an expectation in the market the Fed will cut by 25 basis points in June. That's the definite expectation at the moment.
Now, there is expectation that the Fed will perhaps cut rates in June, but there are also some expectations that there could be a hike. How much of that are you pricing in?
Yeah, so you're 100% right.
I think that's really the... Oh, sorry, you didn't direct the questions. I think we both spoke.
It's okay, Annabel, you can go.
So I think that's the risk. If we do instead find ourselves in a trade war, if we do find the scenario that the Reserve Bank paints, where there are much higher tariffs than expected, 10% universal tariff, 20%, these are real risks people are considering. Then, of course, we could find ourselves in a situation where we do see much higher inflation in the United States, scuppering the chance of a further interest rate cut, or any interest rate cut in the United States this year, and of course bringing into focus instead an interest rate hike. So that's the risk. That's where we stand in terms of perhaps the deliberations. It's something to be aware of as well, that the US would also be thinking about this, and it's not necessarily the outcome they want. The US is looking to promote economic growth. They're looking to cut taxes, cut government expenditure, and of course increase tariffs if necessary to plug the gap from a revenue perspective, but bearing in mind that that would push up inflation, and inflation are one of the reasons why the previous administration lost at the polls, and of course why we now have the Republicans instead of the Democrats. It's been a big concern for a middle class America that there has just been such a huge escalation in prices, where historically they were used to low inflation. So I think that's something that will remain on the radar for the Trump administration. I don't think they're going to be overly hasty and rush into it, but nevertheless, painting scenarios, looking at the Reserve Bank scenario, ones in the markets, should we move into that tough environment of much higher tariffs in the US and of course higher inflation, we get into the territory of interest rate cuts instead in the US in terms of our debating.
Let's get your view on that, Maarten. We have a scenario where there are expectations that perhaps we could get an interest rate hike from the Fed, that also maybe filtering through to filtering through to the trajectory of our own monetary policy. We also have Trump coming out saying that he wants the Fed to cut rates. There's just so much happening.
Yeah, so I think, leading up to the elections in the US, Trump was very aggressive on trade and tariffs.
Yeah.
And that's probably where the market said, well, if that's going to be the case, and then dovetail with that, the Fed pausing, saying, well, inflation might be a problem, and therefore pricing in a possibility of a rate hike first back end of this year going into next year. The reality is, since he walked into the office last Monday, he was actually much softer now on trade. And picked some other countries that he wanted to put tariffs on. And just this week, they also said that the proposal is to start with 2.5% per month and slowly increase it to wherever they want it, 10 or 20%. And that's also very important, because if you slowly rise tariffs, then companies get used to that around the world, or they know that this is coming. So they do prepare to make different arrangements in terms of trade and where they manufacture and where they import and export. So the US can achieve pretty much the same without really taking the tariffs to that level. So if the scenario like that plays out, where the actual implementation is not as aggressive as the first what they've put on table in the run-up to the elections, then inflation might not be that big a problem, and then, you know, they might either stay on hold or we can see another cut. And that's why all that uncertainty gets clustered into the back end of this year, and that's why both the central banks, yesterday the Fed and today ours, are saying, well, let's wait and see what happens later on.
Maarten, it's going to be an interesting 4 years. And that's where we leave things. Thanks to our guests, Annabel Bishop, Chief Economist at Investec, and Maarten Ackerman, Chief Economist at Citadel.